If you're new to all this, I promise the world of investment isn't as scary as some may have led you to believe. And so today we're going to answer some of the most common questions about stocks, namely, what are they and why should you want to own them? So let's start out with, what are stocks or shares or equities? Well, a share represents a fractional ownership of a real company. Owning shares in a company that is traded on the stock market as a listed company is no different from owning a share in a family business, be that a farm, a shop, or whatever else. So when you buy shares in a listed company, you're actually buying a small piece of the underlying business. But almost more important than defining what a stock is defining what it isn't. What it isn't is a bet. What it isn't is a short-term thing. And now try telling half the market that. There's a very large portion of the market that do treat stocks not as a business, but as a sort of magical financial entity that can make or break their fortunes overnight with the right guesses. Real investment isn't about that. That is speculation, or perhaps more simply, gambling. Investment isn't about being a casino and hoping that the roulette wheel spins in such a way that stock prices rise rather than fall. It's not a guess about whether the next price will be up or down. And it's not about trying to choose a popular stock a day ahead of the next guy in the line. Now, granted, some members of the market may treat it like that, and the speed, convenience, and low cost of trading stocks can maybe make it look like all those things. The crucial difference between gambling and investment is that investing in shares offers the chance for genuine ownership of a productive, profitable, dividend-paying enterprise. If you're new, you may ask, what's a dividend? Simply put, it's a payment from a company to its shareholders, usually coming out of that company's profits. So if a company is making good amounts of profit, it can choose to either reinvest those profits into new equipment or research or development, or it can choose to pay those profits out as a dividend to the shareholders. Most companies will do a mixture of these, although some companies like Berkshire Hathaway will actually pay out no dividend whatsoever. Their argument essentially being that they'll be able to reinvest the money better than you will. But it's important to note that for most shares, dividends are a big reason to own them, as they provide returns to shareholders beyond just the movement of the share price. And if you take those dividends and buy more shares with them, you get a wonderful little effect called compound interest, which we'll talk about a lot more later on. Suffice to say, it's very good for you. So wait, why do you want to do all this instead of putting your money just in a bank? Well, the bank actually gives you a pretty poor return on investment versus stocks and shares. Beyond the money they pay you for having your money in their account, the interest, your money doesn't grow in a bank. What you put in is exactly what you get out again, excluding the interest. Whereas if you own a bit of Apple or Coca-Cola, you directly benefit from the long-term success of those companies. When such strong companies continue to generate profits over time, the share prices go up. So the great advantage for the investor in listed equities is that you get to have the opportunity to own a portfolio of great businesses with excellent economic prospects. Another good news is that you don't have to be Steve Jobs. You can do all this once the founders of the business have already done all the hard work for you. You don't have to take the risk of starting your own business, which might fail. And more to the point, you can also own a lot of different businesses, so that if one does begin to struggle, that's not your entire livelihood ruined. This is why every investment expert, manager, fund manager, whatever, worth their salt will tell you to own a diversified portfolio. Diversified simply meaning not putting all your eggs in one basket, trying to own a lot of different things. But if you're daunted at the prospect of having to pick out individual stocks and try to evaluate which ones you think are better, well, you can go for the most diversified thing and buy index funds. Now, if you buy into a low-cost index fund, what you're actually doing is owning a little piece of every single business in that index. So for example, you can put your money into an S&P 500 index fund, which will result in you owning a little bit of the 500 biggest publicly listed companies in the USA. This way you can own the market as a whole rather than owning individual companies, which could lead to bad choices. Although, could also lead to good choices. You can get better results than the market overall if you can pick the right stocks and leave out owning the wrong ones. In any group of 500 companies, there's bound to be a few weak links and also runs, and if you can avoid these, you should generate even better returns. Given the well-documented psychological phenomenon of loss aversion, we know we'll be a lot happier if we just avoid the duds. Understandably though, that's not actually as easy as it may sound. So the safest thing to do, if you're not sure, is index fund. Long term though, especially the more you learn about the market, you really should be looking to have the stocks you choose to own, as well as potentially some index funds for specialist geographies or sectors. So for example, if you believed in the future of green energy but didn't really want to go and try and pick a winner, you could own an index fund of green energy businesses. So where do you even actually begin with all of this? Well, there's no reason you can't select your own stocks, especially if you've got good general business skills or senses. We're going to do plenty of stuff on this channel about the how, where, why, and when of buying stocks and picking stocks, but generally speaking, the safest companies to own are the ones where you understand how they make their money. Companies that are so complex or oddly structured that you don't actually see where the profits lie are usually better avoided. That doesn't mean you'll be right to avoid them. There'll be some great investment opportunities that will sail straight by you because you don't understand the sector, you don't understand the underlying business, you don't understand how to pick the good ones from the bad ones. And it's basically impossible to be an expert in every possible business out there. You might be wonderful at technology businesses, but terrible at manufacturing or terrible at fashion brands or whatever else. But as the old investment saying goes, you can't kiss all the girls. Additionally, we'd advise looking for companies with strong economic characteristics and a long history of value creation. A good marker for this is companies that consistently grow their dividend. A really good marker is being dividend aristocrats. And for sake of this introductory video, one last good tip to remember. If it's in the press, it's in the price. In other words, the companies that pop up most on social media, the companies that get the most news coverage, think of things like weight loss drugs like Ozempic or AI chips or Bitcoin strategy, things like this. They rarely offer undiscovered value. If you think about it, if everyone knows about them and everyone's talking about them and the price is going up, it's unlikely it's undervalued, right? More likely, buying these companies following a big rise in their share price just helps existing owners cash out at inflated valuation, all while the fear of missing out infected short-term outlook pushes the price far beyond any reasonable estimation of the business's value. Putting it another way, if you're trying to find a bit of value that other people are missing, well, the most talked about, the most traded, the most thought about, the most covered areas are unlikely to be the places you're going to find it. But I am starting to delve a little bit deeper into the pot than I really want to with this video. The aim of this channel overall is to present free financial education for all those interested, and if you do have further questions, please don't hesitate to leave them in the comments and we'll try to follow up on them in one form or another. But for now, thank you so much for watching. If you're interested, please do follow along the channel and we'll see you in the next one. Take care.